we are going to deal with the chapter Capital Budgeting or Capital Investment Decision. These are long-term investments. Firms invest their capital or funds in long-term assets with the expectation of getting future benefits. So here investments have to be made immediately or initially, but you get the benefits or returns after a period of time. So capital budgeting is defined by R.M. Lynch as follows. Capital budgeting consists in planning the employment of available capital for the purpose of maximizing the long-term profitability of the firm. So capital budgeting or capital investment decision, the term itself helps you understand what it means. It is actually investment in long-term assets or long-term investments. Now we shall look into the features of capital budgeting, which will give you actually a broader knowledge about capital investment, which means it is investment long-term activities, large amount of money is involved. There is investment of current funds for some future benefit, and these benefits are expected over a number of years. It will take a number of years for you to receive the benefits. It involves a high degree of risk, and decisions are irreversible, and the gestation period is long. That is the period between the initial investment and the anticipated return. Next, we look into the role and importance of capital budget. So the first role of capital budget is that, or importance is that it involves huge investment. So since large amounts of money is involved, we have to be very careful while planning and appraising capital budget decisions or long-term investments. If it becomes wrong, it will affect the survival of the firm. The second thing is long-term implications. Here, these assets are bought for a long period of time. It has a long-term effect on the firm. It has a long-term effect on the profitability, cost structure, etc. So since it is not for a short period, the investments of a long period, it has a long-term implication. Third, irreversible decision. Here, once if you take the decision, it cannot be reversed. You have to be very careful when you invest in such long-term assets which involve or in such projects which involve large amounts. So once you make a mistake, it cannot be taken back. You have to be careful while taking capital budget decisions. Next is the risk factor. Here there is a lot of risk involved. First of all, because there is large amount of money. The other reason is because there is uncertainty in the returns. We are not sure because returns will be in future, and we are not sure whether we will be able to get sufficient returns. So that itself is the biggest risk of long-term investments. Next, fifth point is growth. That capital budget decisions affects the growth of the firm because these are long-term and which involve large amounts. So it actually affects the growth of the firm, right? It is not just a small amount. It affects the survival. It affects the expansion of the firm. So capital budget decision influences the growth of the firm. The next is impact on firm's competitive strength. That is, these are strategic decisions. So if these strategic decisions becomes wrong, what happens? It will actually affect the firm's survival. The firm will be at a loss. So it will not be able to compete in the market. It will lose its competitive strength if it makes a loss or if it does not, it is not able to make proper returns. The next is it is a most difficult decision, yeah, because large amount of money is involved. There's a large investment, large outlay. So we have to be careful. And since it's irreversible also, once if you make, you cannot return back. You cannot then think that this kind of investment is not the right one. There is no use because all these investments are irreversible. So it's a very difficult one. We are not sure whether we'll get benefits. So it's a difficult decision. The next is cost control. That is, here we compare the budgeted expenditure and the actual expenditure and find whether the actual is more than the budgeted expenditure. If it is more, we have to control, or else it is going well. So it helps in cost control. That is controlling the actual expenditure within the budgeted expenditure. And the next point is wealth maximization. Wealth maximization is the ultimate objective of shareholders. Okay, maximizing the value of the shares, maximizing the value of their financial assets. So, capital budgeting helps in maximizing wealth of shareholders, especially equity shareholders. So, the next we're going to learn about capital budgeting process. You can memorize the capital budget process based on 6 P's. Okay, that is project generation, project screening, evaluation, selection, execution and implementation, performance review. So look at the first step. The first step is project generation. Here we either generate an idea or we search for various investment opportunities and which are actually compatible with the firm, okay, which are in match with the firm's objectives. So we look for such opportunities or we generate ideas. That means here we actually identify various ideas, identify various investment proposals. So that is the first step. That is actually identification of project generation. The next step being project screening. So here we actually, uh, check each project, whether it is technically feasible, whether it's financially feasible, whether you have the available resources, whether it will provide you or give you expected returns. What is the risk involved here? So all these are screened. We look into each project and we look whether these are feasible. So screening process happens in this stage. The next is project evaluation. In this stage, we evaluate the profitability of the proposal. We deeply study the project. Here we analyze the cost and benefit, whether the benefit is more than the cost. And we also judge the desirability of the project, okay, whether it is an appropriate project. So basically, we compare the cost and benefit and we judge whether it is going to be a profitable one or not. So that happens in project evaluation. And the next stage is project selection. So after evaluation, if you find the proposal is good, if it is best, we would approve the project. The next step becomes execution and implementation. So once you select the project, you will execute it, you will implement it, you will allocate funds accordingly, and a capital budget is prepared. And finally, is performance review is actually a feedback or a follow-up or a review where you compare the actual performance and the budgeted estimates, and if there is any deviations, we would correct it. So this happens in the last stage called performance review. So these are the steps in capital budgeting which we can remember using the 6 P's. The earlier slide is also related with this process. It gives you the same details, that is identification, screening, evaluation, you're fixing your priorities, then final approval, and then you that or final selection, and then you implement it, and finally performance review. Next, we're going to look into the various concepts to be considered while determining cash flows. The first concept is cash flows or accounting profit. So cash flow concept considers all the actual cash receipts and casual payment. While in accounting profit, we also consider the accrual concept. Here, it is not necessary that the actual receipts and payments are not always considered. An accrual concept is usually considered. So these are two concepts. So here, the advantage of taking cash flows for capital budget is that it considers non-cash expenses also, point one, while accounting profit does not consider the non-cash expenses. The second thing is that there is a confusion in the calculation of depreciation or method of inventory valuation since it changes. These calculation method changes, but that limitation is not there for cash flow approach. And the third thing is that accounting profits ignore the concept of time value of money. So this is the cash flow or accounting profit concept. The next is incremental cash flows. Incremental cash flows actually considers only the difference or those cash flows which are directly affecting the investment decision. For example, there is a firm already has made an investment of 10,000 in an earlier project, and it is going to substitute it with another project which is having a cash outlay of 12,000. So the earlier one was 10,000 and the new one is 12,000. So the difference is 12,000. Again, the returns from it from the earlier one is 15,000 while from the new one is 20,000. So again, difference of returns is 5,000. So here 2,000 and 5,000 are the only figures to be considered while taking the capital budget decision because these are the relevant figures. Now in this incremental cash flows also there are various other points to be considered. The first one is sunk cost. Sunk cost are costs which are already incurred and which is irrevocable. So these costs are irrelevant while considering the incremental cash flows. Second is opportunity cost. Opportunity cost is the cost of the project which is foregone. Okay, it is the cost of the next best alternative which is foregone for the present alternative. So this cost should be considered while determining the incremental cash flow. So you might you might have foregone a project for taking up the present project. Next, the concept of time value of money and inflation. Now, since this is for a long period, you have to consider both the time value and inflation factors. Working capital is the other concept in incremental cash flows. Working capital is the excess of current assets over current liabilities. So what are the various current assets? Cash in hand, cash at bank, stock or inventories, trade receivables or debtors. And what are the various current liabilities? Creditors or trade payables, etc., overdraft, etc. So the increase in working capital is actually outflow of cash. So it is considered as cash outflow, while decrease in cash working capital is considered as cash inflow. So these have to be considered and adjusted in the cash flows. The next concept is the effect of taxes. For capital budget decisions, we consider cash flows after tax. In short, we call it as CFAT, cash flows after tax. So here the impact of taxes are considered and examined for calculation of cash outflow because payment of tax is an outflow. So we consider it for the calculation of cash outflow. And sometimes if there is a savings in taxes, that is considered as cash inflow also. Next is effect of depreciation. As we told earlier, cash flow considers method considers